Okay, so welcome to today's webinar on how to hack your mortgage. Why are we having this conversation now? Well, with record high debt accumulation from debts, renovations, from market uncertainty, from the way interest rates move, there are a lot of people that could strategically use their equity in their home to put them in a better position. And secondly, home values are quite high actually, which presents a unique borrowing opportunity for people that they often are not aware of. It is often the case that it is easier to obtain money from your equity in your home to pay out debts, to pay for renovations, pay for kids' university. Sometimes it's a lot easier than you think. So who are we? So we are Ontario mortgage brokers, very experienced. So 7 years of experience. We have 58 lenders. I actually think we have 59 now. It's always increasing. And we specialize in a strategic approach to financing. So not a one size fits all, like your situation is unique and your financing should be too. And we pride ourselves on creating wealth building mortgage advice for people. Know that there's no cost for our service. So if at any time you want to book a call and chat through your own unique situation, we are happy to do that for you. This is our brag page just to show you that we're really good at what we do. We win a lot of awards each year, which just is a testament to how good we are at this and how many mortgages we do. That volume, it does matter because sometimes we get access to different products, rates, things like that, that not everyone will receive. When I'm thinking about my home, I often think about two things, right? When I think about my kids and my life, am I setting myself up in the best way possible for the future? And am I borrowing the least interest on all money borrowed across everything? So disclaimer, so everything changes with market conditions. Rates are based on that situation on that day at that market. Different rates can significantly impact the overall outline of what we're illustrating. This is my opinion. These are real client stories. They're not fictional. They're just everyday people like you getting really good advice. This is also not based on any one lender's guidelines. We have tons of lenders and they have all different mortgage products that sometimes can fit you better than others. So when we're talking about interest rates, I want you to look at the mortgage contract interest rate and also your global interest rate. So what does the global interest rate mean? So the mortgage contract interest rate, really simple. If you borrow money at 5%, 5% is your interest rate for that mortgage. But what we often fail to look at is other interest rates. So a mortgage might be somewhere between 3 and 6% in a normal market. But what about a secured line of credit? It will be slightly higher. It's actually quite a bit higher right now. What about an unsecured line of credit? Do you have money sitting there at a higher interest rate? Do you have a second mortgage at a higher interest rate? Do you have credit cards at way higher interest rates? Do you have renovation loans or easy financial or cash money loans at much higher rates? And do you have a car loan at a higher interest rate? So think about $20,000 borrowed on a line of credit. So a line of credit is typically prime plus a half. So with most lenders, it's secured. Let's say prime is 7.2, then the interest rate on that secured line of credit would be 7.7. So an interest-only payment on $20,000 would be $126.32 a month. But if we're actually going to pay that off, or we're going to calculate it in the stress test, we use a repayment calculation, and that's $600 a month. If we increase your mortgage by $20,000, let's say the average interest rate today is 5.67%, that would be $114.87 a month increase, but that would actually be going to pay off your mortgage. So to give you a bit of perspective, when interest rates were 2.5%, that would be about $89.59 a month. But again, like when we put it on your mortgage, there's money actually going to the principal to pay it off. It's not just interest only. So let's take a look at a client example. So they had a $230,000 mortgage, which was $1,282 a month. They had $11,500 in credit cards, which cost them $345 a month just in interest. $27,000 line of credit was $360 a month, and a $20,000 car loan, which was $450 a month. So their total debt was $288,500, And their total monthly payment was $2,437. Okay, so $2,437 is how much money they were spending each month across all these debts. When we look at the cost to pay out the refinance, so a penalty to break their mortgage was around $2,500. The legal fees to do this was $1,150, and there was an appraisal of $350. So when we look at this example, we were able to refinance to get a new mortgage that was $292,500. That covered all of the previous debts plus any costs associated with refinancing. We were able to pay out all the debts and make all of these items down to zero. And that cost them $1,517 a month when we were done. So that's a $910 a month savings in total across what they were doing with their hard-earned money every month. If we put that on their mortgage, it would actually save them $75,422 in interest and pay off their mortgage 12.25 years faster. That's the same money. It's the same money going out of their pocket each month, but going on to repaying debt at the lowest interest rate they had access to instead of paying it across all these different items. So what do we need to do to see if your situation looks like this? Well, there's 3 steps to hacking your mortgage. So 1 is assessment, 2 is refinance into the right product, and 3 is automate the prepayments. So with the assessment, we would list all the current liabilities and list all the monthly payments, the same as we just did on that example. We calculate all the totals, review a penalty or any costs associated with breaking the mortgage, and estimate what the current home value is. Then we look for the right products. So making sure that you qualify, looking for good prepayment privileges that are easy to use so we can actually put that extra money onto that mortgage, determine the best amortization, right? So where we want to set that, and then pay off higher interest debts with the new mortgage to improve the cash flow. Lastly, we want to automate the prepayments. So we want to calculate the additional cash flow that you're going to have, determine what amount you can direct towards your mortgage, and automate those payments. And then we touch base. With our clients, it's annually, so we touch base every year to see how that's going. If you have extra money, then we might add on more prepayments. If you're finding life is hard or you have an additional expense, maybe we're taking some of them off. But it's important to look at this every year because we don't want to set up a refinance and pay off all your debts and then leave you and not talk to you for 2, 3, 5 years. And then we get to that point and you're in debt again. That makes no sense, right? So we need to make sure that the product is still working for you in between those mortgage transactions. Okay, so what do we want to do here? We want to reduce your monthly costs. We want to decrease the global interest rate. So not just the mortgage interest rate, but what the interest rate is across all of the debts you have. We want to pay less interest to the banks, and we want to have more of your hard-earned money actually going to pay down the money that's borrowed, not just going to interest. So if you have any questions, we'd love to chat through your options. Advice is free, assessments are free. Give us a call at any time at the office, 289-645-1568. Thanks so much.